Good morning, ladies and gentlemen. We're coming to you live from Sandton, Johannesburg for the launch of the Where to Invest in Africa report for 2024. My name is Nastasia Arendse, and I will be your host for the next couple of hours. The case for investing in Africa has been widely made, and that's because parts of the continent is booming and offers untapped resources. But it's not a singular entity. That's because we've got many economies with differing population sizes, wealth levels, as well as operating conditions. And we can say the continent offers both the best and the worst. Africa offers vastly untapped resources, as I mentioned before. And of course, navigating this terrain can be daunting, even for the most experienced of investors. Deciding to invest is one thing, but knowing exactly which country to invest in, that is something completely different. Since its inception in 2011, the Where to Invest in Africa report has reinforced the message that Africa is open for business. We've guided lots of local and international investors in traversing many parts of the continent in order to basically assess the attractive destinations, and we've based a lot of that on the macroeconomic as well as business environments. In doing so, we've helped a lot of the local firms mold their expansion strategies and reaffirm some of the growth opportunities as well as the growth plans that they are seeing. Each year, what's quite nice about the report is that the team continuously tests their methodology against some of the scorings so that they better reflect the opportunities as well as the challenges that embody each economy. The availability of data over the years has made it quite easy for us to evaluate and also create a position where we can basically change some of the methodologies since the inception of the report in 2011. The updated methodology that you'll find that it will be delivered over the next hour or so is both intuitive and also maintains transparency because it's based on widely available information. So I look forward to fielding some of the questions that you have, not just online, but in the room, and also helping us understand where to for the African continent. Without much further ado, I'd like to welcome on stage Isaiah Mhlanga, who is the RMB Chief Economist, who's going to be taking us through the methodology of the report. Well, we're not going to talk too much about it because we want to leave a little bit for the panel discussion. But without much further ado, Isaiah, the stage is yours.
Thank you very much, Nastasia. Good morning. We are very pleased to welcome you to the launch of the RMB Where to Invest in Africa 2024. After 2 years of a pause in 2022 and 2023 to take into account new data availability that we have now that we didn't have before. Let me start with just a proviso. It has been running for 13 years since 2011. We as RMB, we have deal footprint in 35 African countries, which means the continent is our home. We have been there, we live here, we travel it, we have boots on the ground, we have the nuances to inform investors of what's going on and where are opportunities and risks. In terms of why Africa, the reasons have always been there, and I think they are even more valid today than they've ever been. Let's take demographics, for instance. If you look at the growth of China and now the growth of India, it's rooted in demographics. That offers an opportunity. We look at resources. Africa possesses some of the world's largest resources, which are going to be important in the decarbonization going forward. If you look in terms of land, we possess quite a significant portion of arable land that offers opportunity for growth in agriculture. And then we can also look in terms of the Africa Free Continental Trade Agreement. If you compare with other continents, Africa's trade remains way too low relative to what we see in other continents as they trade intracontinental. It's only 15%. Europe is at 46%. That's the lowest intracontinental trade in some of the regions, which means just merely doubling our intracontinental trade we're going to improve our economic growth prospects as a region. And then the increase in data availability, that enables us to present the opportunities at a much more granular level, something that we were not able to do before, as you will see in a short while. And then diversity. In most cases, Africa has been labeled in a negative way. But in true reality, there are opportunities, there are risks. There is always an opportunity for an investor depending on what drives your underlying business. But there are also risks that you need to be aware of. Just to really hum in on the demographic dividend potential of Africa, if you look in terms of the median age, it's just under 20 years old. Europe, which is one of the large homogeneous in terms of culture, in terms of trade, its median age is double that of Africa. So Africa really has the opportunity to harness this human potential into something that can grow the continent. Now let's look at how we assess the continent from 2011 to 2021. We used a 6-variable model that will take into account hard data, but also take into account some soft and qualitative data that matters for the operating environment. So we'll take into account the size of the economy, we'll take into account the economic growth, and also how the governments manage their fiscal accounts, essentially a fiscal score. We collapse that into an economic activity score. We also took into account some qualitative data that would be global competitiveness, it would be global perception index, but also we had global freedom index. All of that collapsed into what we called an economic climate or economic environment index. These two will be equally weighted to give us a final score of how we rank countries. But that in itself does not tell us what's going on in the underlying economies from a sector perspective, which is why we took an opportunity when COVID hit, the digitization took place, we had much more data available after COVID than we've had before. So we took that opportunity to revise our methodology in a way that gives us a lot more granular understanding of the continent. So we moved to a 20-variable model, collapsed into 4 pillars. The first one, economic performance and potential, with about 7 variables. GDP, which is the size, GDP growth, which is the growth in that size of the economy. GDP per capita give you the ability to assess the spending power in that economy, population growth, population size, and urbanization rates. Combined, this drives about 35% of the overall index. There's a lot of academic research that has proven over time that this is the most important singular measure or pillar that drives investment potential. The second pillar, market accessibility and innovation. We have economic complexity, connectedness, innovation, and import concentration. This gives you a sense of whether an economy is well diversified. Some economies have single commodities, which means they are exposed to risks of an underperformance in that commodity. Some economies, if you take the small islands, they only survive on tourism. If tourism doesn't perform well, it means they suffer. But if you look at some of the few economies in the continent, take South Africa, for instance, with a diversified economy in terms of sectors, it's insulated from underperformance in one single sector. Then the third pillar, which is economic stability and investment climate, that has become much more important, particularly if you consider some of the developments that we have seen so far. It includes forex stability and liquidity, economic freedom, you have inflation, corruption, and political stability. The last pillar, social and human development, that takes into account some of the social aspects such as human development, income inequality, personal freedom, and unemployment. What we have seen in some of the countries that have bad social indicators is that we don't have a stable operating environment in those economies. So even if the population is large, even if the income per capita is also very high, as long as they're not stable from a social perspective, it becomes difficult to invest because the social operating environment is not conducive. So using this model, we are now able to dig deeper into the economies in a way that gives us a better understanding of the nuances within the economies rather than just between economies. Overall, this is the rankings that we have come up with, where you would see the likes of Seychelles and Mauritius being the top 2 ranked countries, and there are reasons for that, which the panel is going to unpack when we discuss. But models need to be tested. We needed to back test the model to get a sense of how it would have performed in the previous year, given that we have had a change in methodology. So we performed that back test to try and see the stability of the different measures. And as you can see, if you compare 2024 and 2023, there is relative stability in terms of the underlying factors. Why is this important? We have a lot of variables, but what we are doing here is to provide a measure that we can look at to take long-term investment decisions. So if the variables produces volatile rankings over time, it becomes difficult to take long-term investment decisions. In terms of the methodology, the data is transformed into moving averages to make sure that some of the once-off dynamics do not overly influence the outcome, but also some of the extreme data points do not also influence the overall outcome. And the panel is going to elaborate more on that. The Africa Free Continental Trade Agreement also offers an opportunity for growth, to my point earlier on. If you look at intra-Africa trade, it's only 15%. The next lowest is the Americas at 46%, which means by just doubling our intra-Africa trade, we have an opportunity and potential to increase significant development across the continent and economic growth. We have seen a lot of countries signing up, and we seem to be gearing up to it taking off properly, which means that opportunity is now real, no longer just perceived. As I complete my introduction, we then have an overall ranking of all of them. I want to underline something that is quite important. The rankings themselves do not give you a complete picture of where you should put your investments in. They give you a starting point. You still have to do due diligence in country for specific investments and specific sectors. By just looking at the overall ranking, which is on the extreme right, you might be surprised, my point earlier on. But if you unpack that in the underlying pillars, you would see what is really driving that overall ranking, which is the underlying pillars that I discussed earlier on that the panel is going to speak about. Africa is not a country. It is a continent of 54 countries that are diverse, that are unique, that have challenges and opportunities. But they also have countries that are driven by common underlying factors that in the report we call the archetypes, which the panel again is going to discuss. Essentially grouping countries according to common drivers of their success, therefore opening opportunity to group them in a simpler way where they are correlated and therefore offering better investment opportunities for specific investors that are interested in that specific driver of the underlying economy. So this is just to give you a flavor of what's in the report. The report is 159 pages long, which means there is a lot of detail that will encourage you to download the report, to read the report, and send in questions, queries to the team. And on that note, let me say a word of thank you to the people that drove the construction of the report. the team at Boundless, which is led by Professor Aldrin Saville. Thank you so much for spearheading the writing of the report. Our editing team, our marketing team that have made sure that the report looks nice, it's readable, and it's a joy to read. I'm sure you're also going to enjoy reading the report. Our editors, thank you so much. The R&B research team, Sam and team, thank you for tireless hours of looking through the report, picking up errors, and making sure that it's good to look on the eye. And of course, the broader R&B leadership that supported, that continues to support the production of this report. And last but not least, and perhaps even more important, thank you to you, our clients, for gracing us with your presence to come and listen to us, sharing our ideas. We hope you are going to enjoy this report and it's going to prove useful in how you make investment decisions in the continent. Thank you very much.
Isaiah, if you can stay on stage just for a little bit, and that just is going to give us a little bit of time just so that the team can help us rearrange the furniture just for a bit. So before we actually get into the details of the report, which we will do in a short bit, I'm sure for a lot of us who are curious, putting this data together can be quite daunting. How long did it take to put this report together? I mean, you've thanked quite a lot of people here, but perhaps you can give us a bit of background here in terms of how long this project took.
Look, the planning takes quite a bit of time. It's looking at many countries across the continent, so you still have to plan to say what will be the themes of the report.
Right.
And once you have settled on the themes that are relevant in a particular year, then you start the data collection. So in earnest, you could say the actual thinking and deliberations of the report started at the beginning of the year.
That's quite interesting. So a lot has happened between the last time we got the report in 2021, if I'm not mistaken, and right about now, 2024. The world has changed, and I'm sure a lot of people in the room are aware of some of the aspects that have changed. But what has surprised you the most as you went through aspects of the data gathering? And I'll ask Prof the same thing as well as our panelist, Samantha.
Yeah, there was one data point that gave us some sleepless night, okay. Me and Sam and Tim. So we look at the population measures, we see Seychelles' population has grown by 20% in 2022. But the average growth rate from 2019 to 2021 was about 0.9%. Okay. So that just looks odd. So we tried to figure out, is it the data that is correct from the source, or do we transpose the data incorrectly? So we go to the source, it's still the same, yes. 20% growth. It's about 99,000 people the previous year, and then it jumped to 120,000 people, which doesn't make sense if there aren't any special measures. But I would then encourage the readers to go and read and find out why.
Okay, good. Okay, if you can kindly have a seat, and then I'm going to welcome the rest of your panelists. So to help us unpack a little bit more about this particular report, you've heard a little bit about him. Please welcome on stage Professor Adrian Saville. He is a professor for economics and finance at Gibbs, and he'll be joined by Samantha Sengjami, who is an R&B Africa strategist. Yes. Thank you so much to the panelists. So as I mentioned, we are also going to be taking questions from the room as well as online. So please feel free, if you have any questions regarding some of the countries, and maybe you have country-specific questions, please feel free to raise those. Samantha, let me come to you here. I mean, it's quite interesting as Isaiah gave us a little bit of an overview. He spoke a little bit about the actual pillars, but talk to me about the metrics, why these particular metrics were picked. Perhaps you can take us through that.
Okay, great. Thank you so much for the question. So I think we've, the one thing that Isaiah mentioned is the data availability. Right. And given that the The initial Where to Invest started in 2011. There's been a lot more changes in data and more data availability for these countries. So a lot of them have been working with the likes of the IMF, World Bank, to produce a lot more data and series. And I think we've taken the opportunity to look at it more intricately. So economic stability, I think when you're looking at countries to invest in, the economic performance and stability are obviously very important. But then things like innovation and human and social development also need to take into account. So I think we've just tried to make the Where to Invest a little bit more robust.
Okay. The one thing, Prof, many would have seen in the report, and maybe perhaps some are not statisticians and they may have missed this one, was the use of Z-scores in this particular report. Why was that the case?
First, Anastasia, can I just do this?
Okay.
Isaiah makes it sound very easy. Okay. Not many data points, gazillions of data points. So to square up to your question seriously, you say Z-scores, I'll do the South Africanism and say Z-scores.
Okay.
Same difference. And when you're measuring across these four different pillars, you're putting together the measures in each of these components have different units. So, for instance, economic growth is a percentage unit. And if a country grows fantastically, it would have 4 or 5% economic growth. You have other percentage measures in here, for instance, inflation. And some countries are scoring, well, we've got elevated inflation rates in places, 30, 40% inflation. Now, how do you put these two metrics into the same bucket when one has got a maximum of 30 and the other has got a maximum of 5? Then, to complicate it further, you've got other units of measurement like GDP per capita is measured in dollars, etc. So what a Z-score does is it essentially strips the metrics of the units, and then it also measures you against your peers on each of those dimensions, essentially asking, how you could think of the height of a class. And when you go to grade 3s, the tallest person looks very different than the tallest person in grade 12. And so what we're doing is we're standardizing each of these for the grades or the dimensions that we're measuring in. And in that way, the Z-scores allow us to compare apples, oranges, pears, and bananas.
Okay. That's a nice analogy. And the one thing people will also find is that there's a very interesting football analogy in the report. And it was a nice analogy.
So Mbappe is
yes,
Mbappe
I have to
is
say,
the
I
rock
don't
star.
know who any of these players are, but I will continue reading the actual report. I want to stay with you, Prof, on this one, because as I said, that you'll be able to take us through the archetypes, and there were quite interesting names that you picked here. Sure. One is the high flyers, the other is cleared for takeoff. Then you have another archetype, people potential. The other is global connectors, and then we've got the low base boomers. Let's talk about what these 5 archetypes are.
That's a lovely question, and perhaps I can steal a little bit from Isaiah and say, well, go and read the report. Or encourage others to read the report for detail. There's a risk when you arrive at a final ranking and you say Seychelles, Mauritius is 1 or 2, etc. And people do a lot of head scratching and think, well, I wouldn't go there. Why would I go to a country with a population of a few 100,000? If you're going to sell disposable diapers to a mass market, Seychelles or Mauritius aren't your destination markets. Whereas Angola, Ethiopia, Nigeria might be more obvious places to go. And that's exactly what the archetypes do, is they try and put on the lens of the investor and think about elements or components of the country, whether it's population size, economic growth, that matters. And so, for instance, our low-base boomers is a consideration of what we think are markets that are ripe for companies that are looking for to sell product to relatively lower income consumers. So if you're looking to sell Aston Martins, Maseratis, this probably isn't your market. But if you're looking to sell entry-level product, these may well be your markets. And what would make those markets attractive would be the fact, actually, that they've got low per capita incomes, that they're growing quickly off those low per capita incomes, excuse me, that they're growing quickly off those low per capita incomes in terms of both population and income per person. That makes it a market ripe for your product, which might be toothpaste, toothbrushes, disposable razors. And that's the thinking in constructing each of those archetypes. Similarly, you make reference to countries that are innovators or connectors. Now, Mauritius and Seychelles stand out as countries that integrate and connect with much greater ease. So if you're looking for ways in which to allocate capital to Africa en masse, then Mauritius might be an obvious destination. So this is the attempt with each of the archetypes, is to try and put on a lens or a cap of different types of investors and different types of businesses.
Okay. Azai, let me come to you here, because if you look at the different, the pillar rankings, so you've got economic performance and the potential and the weighting that it has and market accessibility and that particular weighting. But what I found quite interesting is that if you look at economic performance and potential, the weighting there is 35%, if I'm not mistaken, and then economic stability and investment climate is 25%. When we look at the other ones, where it has to do with market accessibility and social and human development, do you find that over the years, in your experience, that investors care about the social and human development aspect, and they care about the fact that an economy can think outside of what is actually the main, probably call it GDP driver or growth driver? What's driving that interest in saying, actually, as much as this economy is great, what's going on the social and human development side of things?
Investors care about it, but I think I'll answer the question partially because we had a prior discussion with Prof, who has a particular point to make as far as impact is concerned. So I'm not going to answer on impact. I'll leave him to elaborate on that. If you look at Middle East and North African countries that have had an unemployment rate of around 15%, and at that level, they had civil unrest. Those economies becomes difficult to invest in. So the social aspect, which is unemployment, makes those countries difficult to invest in. Remember, at the end of the day, all businesses are given the right to operate in any economy by the citizens in that economy. And if the citizens are not gelling well in a socially stable environment, it becomes difficult for you to actually deploy capital in those economies. So social stability matters, first and foremost, for any business. So that's why we have to look at social and human development. But again, if you look at some of the economies globally, even here, we can take Rwanda, for instance. The improvement in the social aspects produces a stable operating environment, but it is also the genesis of skills which are required by investors. So that skills, ability for an economy to produce good skills is captured in the social aspect of the indicators. So they are important. You can have a mass market Nigeria, you can have high income per capita. As long as the social aspect is not there, it becomes difficult to operate. That's why we took it explicitly into the rankings.
Prof?
So I love the point that Azai makes about having social license to operate. It is the society that gives you the ability to operate. In sitting behind this work is a really important bureau of literature, evidence on market access, market entry, the performance of companies in country. And this social dimension is an absolutely critical component. Perhaps to put it in a slightly different way, if your business is doing well but society is stumbling and stuttering, you're actually running an extractive enterprise. And you'll run out of runway in the fullness of time. So this dimension that the social human capital development component brings, I think, is an absolutely fundamental lens to think about the performance and the longevity of your business in country.
Could I add to that? I think when you're looking at social and human development, you're looking at broader ESG, sustainable goals. A lot of countries are now financing themselves through some of this. So you get things like social impact bonds and development impact bonds. So I think it starts to play a more important role as we go forward.
Okay, so I'm sure a lot of people in this room would think, well, if your team was based in Seychelles, or if you were told tomorrow that you can work from Seychelles or Mauritius, a lot of people would be like, that sounds like a really nice idea. I mean, the beautiful countries. But let's talk about some of the practicalities, Samantha, of investing in small markets or small economies like Seychelles and Mauritius. What is there to bear in mind when you look at that?
So I think when you're looking at it, maybe you can look at something more sector specific. So obviously, in relation to Seychelles and Mauritius, apart from wanting to have offices there, I think you'd look at the tourism sector, which would be one. There's also growing IT, IT and innovation in both those economies. You get a country or island like Seychelles that has this huge blueprint for a blue economy, and you look at maybe the prospects of Seychelles in that regard. So using the marine assets basically for sustainability going forward. So I think there's a lot of aspects to look at, and when you look at maybe the smaller sized economies, you see that they do relatively well on the human and social development, which we also touched on earlier.
Okay, I know there were a lot of people who over the years have followed the Where to Invest in Africa report from 2011 all the way through the years. And perhaps the last picture they may have had of the 2021 report was when you look at the top 10 countries in terms of overall rank. You had Egypt, Morocco, South Africa at third, Rwanda, Botswana, Ghana, etc. But this time it's quite different. We don't see Rwanda in the top 10 of rankings. We don't see Botswana. We also don't see the likes of Kenya and Tanzania. They're there, but they're not in that top 10. Take me through what has happened between 2021 and now. And yes, you did mention you've added all these other metrics in place. But what has happened in some of these economies where investors may have thought, I like Rwanda, I like the idea of being in Kenya, etc.?
If you look in terms of the change in methodology, which is quite important from a data perspective, but also to provide granular understanding of the countries, that really drives the change in terms of the rankings. But it is also why we also took an opportunity to back test to 2023 scores so that we can compare with this year's scores. And what you have seen is the scores are quite stable. There is change still. As some of the variables change, they can influence the overall rankings, but that change is not drastic. But secondly, this, we believe, it's a better way to look at economies. Previously, in the previous methodology, it was dominated to a large extent by the size of the economy. That would always dominate. Hence, you saw the likes of Nigeria, Egypt, South Africa ranking always in the top 10. But that is not the only determinant of investment attractiveness. You can have a large market, but if it's difficult to take money in and out of that market, it becomes difficult for a financial institution. But if you are a pharmaceutical company that is not so worried about the ability to extract money quickly in and out, then you are better served in having 180 million people that are buying medicine every day. So all this says is this gives us a better view to understand economies, but what we need to do is to look at what really drives our underlying businesses and look at the countries that are classified, or at least that are driven by those underlying characteristics. So this becomes quite important. So for instance, if you want the ability to easily export to multiple countries, then you are better off being based in a global connector, for instance, because they have well-diversified sectors, they have much more linkages with other countries globally. It becomes much more easy for you to base your operations in that country, but you still produce for the rest of the world. So it's those dynamics that come through from this methodology that were not there in the previous methodology.
Okay. Prof, we can talk about the ease of doing business and all of these other metrics, but the other thing that has constantly come through every year from other investors or different other panels has been the infrastructure quality and sophistication and the infrastructure gap. If we're to take in that infrastructure aspect, where would it fit in any of these rankings, or is it something on its own for investors to consider?
Sure. How long do we have? So first, where it fits is it belongs in the economic performance and potential, because infrastructure, all considered, is one of the single most important drivers, pun intended, of sustained economic growth. And where you find economies that have elevated rates of gross domestic fixed investment, that translates almost automatically, by definition, into elevated and sustained growth. Now, some of the leaders in terms of that infrastructure development put their hands up quickly. Ethiopia has made big advances. Tanzania has made big advances. Zambia is making gains. So that's a first consideration. Keep in mind, though, it is only one dimension, and I think if I'd like to just come back to this point if we have a moment, but keep in mind that that's only one dimension. But just to give you a sense of the extent of the opportunity or the size of the deficit, depending on whether you want to be half full or half empty in your perspective. The Economist, in the last week's edition, produces an absolutely staggering statistic that if Africa is to develop rail infrastructure with the network sophistication or density of India or China, Africa needs to make an investment of $100 billion per annum. Now, that is an extraordinary number. And to try and get a gasp from the room, how much has been invested over the last decade? $6 billion. So there is a massive, massive infrastructure deficit. This is off the charts. There isn't a Z-score big enough to do this. But it also helps really underline the point that Isaiah was making about Africa is not a country. Africa is not a place. And you have to consider these countries on a case-by-case basis. And we can quickly find the economies that put their hands up in terms of making big strides and advances in infrastructure.
Okay.
Perhaps let me add, as much as infrastructure is on the economic and performance and potential pillar, it can also be on the social and human development. If you consider
absolutely
clinics, schools, that contributes into human development. Yeah. So if you are an impact investor that cares about education, therein you can invest in social infrastructure that can produce the skills the continent requires.
And human mobility.
Yeah.
That infrastructure and mobility can be virtual as well as physical. That I've got the ability to jump into transport and move from one city to the other. Or move from peri-urban to urban, and it might also be virtual. I know that we've got a bunch of people online this morning. That's virtual connectedness. So infrastructure brings all of these dimensions in terms of critical network industries.
And what I'm loving about the people that are online is that they've already started sending through their questions, so we have a lot to unpack in a short bit. But let me come to you, Samantha, here. Is there a correlation between the where to invest in Africa rankings or scores and investment flows into some of these countries?
Okay, I think if we stick to some of the FDI numbers that we've seen, I think when you relate FDI to the size of the economy, so an FDI as a percentage of GDP, you probably see a lot more correlation. But what we do see is that, a lot of the larger economies do attract a lot more FDI, and those economies that are more complex in nature. So they have a lot more products and services that are going on, but they need more infrastructure coming through. The other place where we see a lot of FDI coming through is in countries where there's natural resources and development for that. So, for example, you have the likes of your Senegal, Mozambique, that are starting to produce gas. And so there's a lot of development around that. There's countries like Ethiopia, which are big in population, relatively big in terms of the economy size, where there's low labor costs, supply of electricity is great, and so you see a lot of FDI coming through in some of the manufacturing sectors. So I'd say the pillars do play a role, but again, you still have to slice and dice it to see where some of those flows go through.
Okay, so I'm going to slice and dice. I'm going to take your word and slice and dice into the actual countries. So we spoke a little bit about Seychelles and Mauritius, and I know there were questions that have come through online around Seychelles and Mauritius. So I'm just going to put the Seychelles on the side, but I want to talk about Mauritius in particular. So when you look at the actual report, yes, tourism, that's what we generally associate Mauritius with, but there are other aspects coming through, ICT, insurance, and finance. The one thing when we talk about Seychelles, we say, well, they need to diversify their economy outside of tourism. What else could Seychelles do? Are there other sectors within the Seychelles economy that look promising in order for them to be able to diversify, like the likes of a Mauritius, where they are, again, in ICT, finance, and insurance? I don't know who wants to take that. Isaiah, you're looking at me, so I'm going to field this one.
I could start as well. Okay. So I think with Seychelles, I did mention the blue economy blueprint, right? So just focusing on it's an island, so marine activity and how to make that more sustainable. There's also a strong ICT sector growing in Seychelles as well. Mm-hmm. So I think outside of tourism, you do have those pockets to look at to start with.
Did you want to?
If I could add, I'll respond by giving an example. Singapore, it's a small island, no natural resource, very small in terms of the population, but it's a high-income country, very well developed. Something similar that can be, taken as an example by the likes of Seychelles and Mauritius. Their economy grows on the basis of skills development. They are a net exporter of skills into the rest of the world, and over time, when those skills become older, they bring the technology back into the country. Something China has done as well. That's something that we can say some of these countries can do. If you don't have natural resources, you have human resources. That can be a skill that you export.
We'll talk about the China aspect because I'm sure that's going to be very interesting in a bit. When we were talking about the 2011 rankings, I mean, yes, you mentioned the methodology and everything else that you've put in here does change things a little bit. But at the time, we had Egypt being number one. This time, Egypt is roundabout at the third level. And you talk about the model capturing two extremes. Prof, do you want to take me through some of the extremes that the model captures when it comes to Egypt? What's happening in that particular economy?
So perhaps I could use that, just to go back to my ask earlier, if I could speak to the construction of the model. Having built similar types of tools across industries over time, there's a very high risk when you build this type of framework that a single thing could cause a country to change or move. And Isaiah made reference to this in his introduction to the ranking. So what we've got, going across the four different dimensions is these 20 components or 20 elements. Each of them is Z-scored, which means we've we've truncated them, we've lopped off the ability of outliers to pull countries around, that one dramatic move in a single number is not going to have the capacity to allow a country to leapfrog or to plunge or plummet. The second is we've smoothed data. So for the most part, we're not using a single year's data. We're using averages smoothed over 5 years. So this cocktail of Z-scoring, truncating, or to use the fancy statistical term, Windsorizing the data, and then using moving averages, gives us a really stable framework. Now, to come to your question about Egypt, what causes Egypt, or what pulls Egypt down in particular in recent years has been the economy is good, market access is relatively good. It's the other two dimensions that pull this down. It's the human development score that pulls it down, and it's the investability. I'll avoid eye contact, but I know people in the room who've had currency trapped in Egypt. And this presents part of the problem, that Isaiah is referencing, that you might be able to get your money in, but you can't get your money out. And all of those factors need to be brought into consideration, put all of those dimensions together, and that explains why Egypt falls down the table, but it doesn't fall all the way down. I also want to make this point while I've got the mic, is this is a ranking of 31 countries. If you're at the bottom of the table, it doesn't mean you are uninvestable or unattractive or not a viable destination. It means that you rank 31st in the A class.
Okay. Let me stay with you, and I'm glad you brought up the idea of you've been able to put money in and not been able to get money out, because there are other countries, we've had issues with Nigeria being one of the other countries. But I want to bring in another dimension here when it comes to the regulatory landscape. We've seen a lot of our SA companies have a bit of a tough time when it comes to dealing with regulations of different countries where suddenly they can turn up the heat, and now you're having to deal with dealing with the tax authority or whatever other issues that may come into play here. Does that add in the risk factors when you want to consider to invest in certain countries?
Can I?
Sure.
So, one of the things that we constructed, and I'll attribute this to Sam, who really underlined the importance of this, of being able to enter and exit the market, not in an extractive way, but for investors to have confidence in going into the market. They need to know that they can get their currency in, that they'll be able to get access to capital markets, not just outside of the country, but inside of the country, and that they'll be able to repatriate dividends. So out of that, we built into the the investment climate and the stability score, we built this foreign exchange component, which has going on underneath it. Most of the elements are single dimensions: GDP per capita, population growth, etc. But the foreign exchange liquidity and stability has got a range of different dimensions underneath it, which include in that cocktail months of import cover, the independence of the central bank, the stability of the currency, and so on. And that gives you, I think, a valuable sense of your ability to get money in and get money out. And now let's use 3 practical examples from recent times where we've seen very big adjustments in currency, which changes other dimensions of the model. And those 3 countries are Malawi, Nigeria, and Egypt, which over the course of the last 6 months have all experienced substantial devaluations in the currency in the order of 40-50%. Now, when you're converting your economy back to dollars and you've had a central bank devaluation of 40 and 50%, that makes your economy, all else equal, relative to the rest of the world, much, much smaller. It also gives you clues about currency liquidity. So I'd encourage people also not to see these as standalone pillars, that these are 4 things that are each measured, or 4 pillars each on their own. They're inextricably intertwined. Each feeds to the other.
Samantha?
I think just to add on that, so when we looked at forex stability and liquidity, and Adrian mentioned some of the factors that went in, but we also looked at things like, debt, because you now need, ample foreign exchange supply, but obviously if a country has high debt levels and need to start servicing those, they could sideline, market dynamics for paying off some of this debt. So it was quite intricate. And as Adrian also mentioned, I mean, we've had countries obviously with a lot of liquidity issues, some that continue. But I think broadly, there's been massive reforms on the continent, and those liquidity issues seem to be getting a little bit better.
On the issue,
maybe I could add there. Had we produced this report last year, you would have been able to anticipate some of the devaluations that occurred.
Yeah.
Well, some of the countries that devalued, they were ranked very low on that score. The likes of Nigeria, very low, which means going forward, if market accessibility, liquidity is something that matters to you, you have to look at, are your countries of presence ranked very low in that measure? So get hold of the report and make sure that you understand where your countries are measured. And we do have a lot of colleagues here that are experts in analyzing currency risks and all these other risks that can help you to navigate those risks, should your countries be ranked low on those scores.
Just very quickly, I mean, the economists have arrived, right?
yes.
Very quickly, so if you look at this forex stability and liquidity component, it will flag very quickly countries that have got elevated debt to GDP in foreign currency with high servicing costs, running current account deficits. You have got a formula for a currency, maybe not a currency crisis, but you've at least got the makings of a currency storm.
Okay, so let's stay with the debt bit for now. During pre-COVID, you may have had countries that may have wanted to service their debt. Suddenly COVID hit, and you've now had to redirect resources to health facilities or whatever may have been the need for that economy at the time. Since we are now in a, call it post-pandemic part of the world or part of time, are we seeing that there's some countries that are now a little bit better? They've gone back to trying to service that debt and steer themselves back on the straight and narrow? Or is it a case where they're still trying to pay catch up because all of us were basically just thrown in with this pandemic and we had to sort of put out fires? Samantha?
Yeah, I think, we've seen restructurings on the continent, so it hasn't been easy going through some of these economic shocks. It's become, countries which initially started off with liquidity issues ended up having solvency issues, and hence, restructurings in Zambia, the likes of Ghana, Ethiopia. It's questionable why they went through a restructuring, but that's for another conversation. So there has been pockets of that, and a lot of countries have been thrown into IMF programs, some of which by force to help them get to help them restructure and get their fiscal balances back on track. So we are seeing some improvements, but I don't think we're out of the woods yet. There's still heavy debt service burdens for a lot of our countries, including the likes of Kenya, where we started to see protests when they've tried to increase some of the tax revenue. So I think we are in maybe a situation where the dynamics have shifted a bit. There is fiscal consolidation going on, but I think there's still near-term challenges to be overcome.
Yeah, perhaps it's important to highlight the fact that this is a new methodology. It's not directly comparable to the old methodology. It's almost comparing a full diesel vehicle to a hybrid model. This takes into account the old variables, they are all taken into account, and then we have new additional factors that gives us more information. So we can't directly compare this year's rankings relative to the 2021 and the years before. But we can still uncover, if we just look at the economic performance and potential, for instance, that gives you a lot of what was in the old model. but the other factors such as the economic stability and investment climate might not be directly comparable. We just need to make sure that you have that in mind when you're looking at previous reports relative to this one.
When it comes to South Africa, I know a lot of people might be like, well, what new information are you going to tell me about the South African economy and South African dynamics? But then we had, the election, we in a GNU time period, and I'm pretty sure, there's still quite a lot that we need to sort of focus on from an economic perspective. What do we uncover about South Africa that some may say, well, tell me something new? Isaiah?
Look, I think South Africa is one of the countries that relatively ranks well across all reports from when it started in 2011. If you look at the underlying components, you can see why. It's a large economy, it's well diversified, it's well connected. And in fact, on the connection, I was having a conversation yesterday with one of colleagues, John Keynes here, and he just brought to my attention that in terms of the number of countries that a country trade with, South Africa is either number 3 or number 4 in terms of many countries that you trade with. Number 1 is China, number 2 is the US, and then you have South Africa, which means it's well connected. So it has tended to perform relatively well on all those underlying factors. But the one where it underperforms is on the human and social development. High unemployment rate, the most unequal country. But it also offers an opportunity for policymakers to change the future. Remember, these models are not cast in stone. Yeah. They don't predict where you end up. They give you the tools of analysis. So for a policymaker, it will then inform them to say, if you want to be much more attractive from an investment destination perspective for investors that care about social infrastructure, for instance, you have to do a lot more work in terms of the human and social development. So that's how this report can be used by policymakers, for instance.
Okay. Samantha, let's talk about Botswana a little bit. I mean, it's the highest rated sovereign country, both by Moody's and S&P. Does that translate or play any role in translating into higher rankings? Do ratings matter when you compile all of this data together?
It matters to some extent, right? I think for Botswana, when you look at some of the economies that are smaller, and especially in Southern Africa, they're very reliant on South Africa. So you get a large portion of their fiscal revenues coming from South Africa. Botswana, I wouldn't put Namibia there yet. I guess we can put Namibia there until there's more development on the oil and gas front, but very reliant on minerals. So when you look at the export sector, it's still very reliant on minerals. And then when you look at imports, it's very reliant on South Africa for a lot of its imports. So I think when you think about economic complexity, some of the smaller economies do fare relatively low compared to some of their counterparts. Again, I don't know if I mentioned the social and human development. So I think there, in terms of unemployment as well, Botswana ranks relatively low.
Okay.
Yeah, maybe just to add to Sam, you can take Botswana in Namibia. Their exports are quite concentrated in few commodities, which then means if you have a shock in commodity prices for what they export, they can underperform quite easily. To Sam's point, their imports largely from South Africa, which means in terms of the complexity or export complexity, they rank quite low. That drags their rankings in the overall index. The size of the economy, they're very small, even if they grow very high, but the size itself drags them lower. So they are exposed to single shock to an important variable that drives their economy, which are commodities.
Okay. Last year, probably around March, we had RMB open its U.S. representative office in New York. And I'm curious, over that time period, a year and a bit, are you seeing that interest coming in, or are you hearing of that interest coming in from U.S.-based investors about certain parts of the continent, certain countries? And Are there particular sectors that they're looking to want to, inquire about or need assistance in, or they want to understand the sort of, call it the narrative around those particular economies? What are you hearing in terms of those interactions?
There is interest. We hosted some 15 to 20 clients at the FDB, largely from the US, coming to talk to policymakers about investment opportunities in the continent. There is this so-called the new scramble for Africa, which is coming back again in the market. The need to decarbonize economies mean Africa has an opportunity because we have many of the minerals that are used in the decarbonization process. If you take, for instance, for anyone that has an iPhone here, there is a component that comes out of Africa in that iPhone, which means there is a lot of interest from that perspective. But again, to our discussion earlier on infrastructure, if you are an impact investor with a lot of patient capital, Africa offers that opportunity. To Prof's example, in terms of rail, we've invested only $6 billion over the last decade, but we require $100 billion just for rail annually. That offers you an opportunity for investment. So we are seeing this interest. It's all over the place in terms of the sectors because different businesses are looking for different opportunities. Hence our discussion of the archetypes, which gives you exactly that analysis in the report.
Is there someone who can speak about, perhaps in terms of what you've seen or what you've heard when it comes to the China interest? Because others can say, well, China came in a big way when it comes to the African debt market. And because we're now talking about this scramble for Africa again, are we going to see this thing where it's the US and China again trying to get as involved as they can in a lot of these economies? I don't know who wants to talk about the China role here in that driving of investment, etc. Are we seeing anything? Are we hearing anything with regards to that? Prof is looking away from me, so I'm hoping.
Maybe while they think...
You want to bring me onto the political ice.
Maybe while they think about more sophisticated answers, I would say... Africa is in need of capital.
Yeah.
Africa has resources. Africa has potential. So the way that we should view the other regions that trade with the continent is an opportunity to get capital into the continent. And that's what one of the main reasons that we exist in the continent is to link countries that has a need for capital with those countries that are looking for investment opportunities, but also those that are looking to make investment impact. So if you look at China's typical type of investment has been largely into infrastructure, which is what the continent requires. So it's an important source of capital, but it doesn't take away from the capital that traditionally comes from the US, from the Europe. That still is very important. To a large extent, many economies still depend on capital that comes from those two regions.
Can I have a go at this, Anastasia? So first, just stepping back from the single country considerations and thinking about the continent en masse, I would venture that Africa today is positioned where Asia was in the 1960s. Now, if you think of how Asia has performed from the 1960s to now, there have been some stutterers and stumblers, some great disappointments, some that have been filled with promise and just really never cleared their throats. There have been some very recent late bloomers. Vietnam is a fantastic example. A spectacular burst onto the export stage. And then you've had these remarkable successes. Taiwan, Singapore, Hong Kong, Japan, of course, is pre-1960s, 70s, but just these extraordinary successes. And I hope that gives, in part, really underlines the point not to think of this as a story about a continent, but rather a story about countries. The second is, my second point is, Isaiah makes reference to these critical resources and commodities that are still being extracted, and that the way infrastructure historically is set up Pan-African is as extractive infrastructure. It's rent-seeking infrastructure. Generally, let's play a random game. Name a company in a country that is a foreign investor, and it is likely to be either a minerals business, an FMCG business. Those are the more likely. In other words, it's taking things out or it's selling things in. So how do we build more inclusive, impactful companies in country? How do we build companies that produce in country? And for that, an absolutely necessary precondition is this network infrastructure. Now, I'm not going to answer your question. I'll rather say this. Whoever builds it will command the economic and the social height.
I'll accept that answer. Samantha?
I think I could add to that, just thinking about sort of FDI stocks versus flows. If you look at the stocks in Africa, I think it's largely held by the likes of the Netherlands, UK, and US, so they hold sort of the highest stocks. But in terms of flows, obviously you've started to see a lot more in recent decades coming from the likes of China, the UAE, to the likes of Egypt as well. So I think there's also that dynamic to consider.
Okay, so I'm going to ask one last question, or rather pause my side of questions. There's quite a lot that has come through online, so I want to get through as many of them as possible, as well as questions that come through from the room. Prof, I want to come to you for this one. A little bit earlier on, we spoke about the impact side of things when it comes to impact investing, and that got me thinking around environmental risks.
Yeah.
Do you consider those as well? And when it comes to environmental risk, would they be in the social and human development aspect, or is it more economic performance and potential?
Wow. Without question, this belongs in your consideration. My colleagues here, Ian McLeod, Narissa Pillay, they worked on this part of the work. And the one part that I'll grab for is work that comes out of Notre Dame Institute, and they measure two dimensions of vulnerability, which I would regard as the flip side of impact. A positive impact makes people less vulnerable. It's about inclusion, weaving social fabric, upliftment, and so on. And from a vulnerability perspective, now we can speak about Africa as a place, if you'll forgive me or if you'll excuse me in this instance. Without qualification, the most vulnerable place in the world to climate change is Africa, and the least prepared place in the world is Africa. And this underlines the point again about how absolutely critical this infrastructure and network infrastructure is. If the world thinks this isn't a problem, then you only have to look at what happens when people get displaced and you land up with refugees. Now turn this into tens of millions of climate refugees. So this is a global problem that demands attention from impact investors around the world, not just people interested in Africa.
Okay. So I'm going to open the floor to questions. I know we have a mic moving around, so if you can stand up and state your name and tell me who you want to direct your question to, or if it's open to the panel.
Good morning. I'm Darren from Engineering News. So South Africa was ranked 29 on the social and human development score, which is kind of a stark contrast to us being in the top 10 on the other three pillars. Number one in market accessibility and innovation. I'd like to get an understanding from the panel as to why we're in that position at number 29 on that particular pillar. What drivers put us there, and how can we get out of that? And then just to also comment on how this is starkly contrasted by our being number one in terms of accessibility and innovation. Thank you.
Who wants to take? Well,
okay, let me perhaps give it a step. If you look at South Africa's social and human development, it's what variables go into that is unemployment rate, it's the human development itself, we use a human development index, and on both South Africa underperforms. And then you can add inequality. We are the most unequal country in the world. So on all the human development and social development indicators, South Africa underperforms. That's why it ends up at as one of the last countries in that ranking. That is 20% of the overall index, which means as long as the other 80% are relatively high ranked, this does not drag South Africa significantly down. That's why it ended up at number 4. But it matters because you can't sustain an economy at least until a very, very long time when the social aspect is not stable. Therein lies the risk for this country. It's in the social stability. Just to backtrack a bit to give an example, the scenes that we saw in July 2021, they have genesis part in politics but also in the social aspects. When you have unemployed young people en masse, it becomes difficult to assume you are going to have a social environment that is stable indefinitely. We have to address the issues of unemployment. That would improve the investability of the economy. One of the things that we always talk about is the lack of skills in the country. Many companies, the financial sector included, they find it difficult to obtain specific skills that are required by the economy. Yet we are a country with the highest unemployment rate among peers. So there is a conundrum. No skills, high unemployment, which means it's a cocktail of factors that is ripe for a social instability. You could almost say it's a miracle we haven't seen what happened in the Middle East and North Africa, because their social instability happened with unemployment rate of 15%. We have double that, yet we have been able to have a relatively stable social environment. You could say why that has been is because of the availability of social support from the government. So the way that you would interpret your social grants, you would say is the price we pay for social stability. If that has to be taken away, it means we can end up with a socially unstable country. But that in itself does not mean we need to perpetuate social grants forever. We need to find ways to transition people out of government support into employment. That's the more sustainable route to ensuring social stability. Long answer to a short question.
Yeah.
Could I, sorry, I know that there's another question, but just to add to Isaiah's point, you'll see tucked away in the economic performance and potential score is what we refer to as a structural growth component. And structural growth references that if you look at population growth, productivity potential, I've got some former students in the room, so we refer to this as a solo growth model. That might get a chuckle. Or a Harrod-Domar growth model, which is the investment-led growth model. If you put those two dimensions together and you weigh that up against South Africa's population growth, we're not fit for purpose. That we struggle to produce structurally economic growth that even approximates population growth. And so that leaves us in this quagmire of this bog of social. We're socially stuck, and Isaiah's referenced dimensions of this: the inequality, the unemployment, and it's not that we have just unemployment; we have elevated youth unemployment. And these are the dimensions that we're referencing. So Natalie Claw-Wilson, she popped out for a second. I'm glad you're back, Natalie. But she builds this dimension into the model, looking at the various social components. And here South Africa fails by a very, very wide margin. And I'll reference again an earlier point that Isaiah made about if there are lenses that can be brought from a policy perspective, there is an unquestionable component here that speaks to the South African policy imperative.
Okay, I know we've got another question there.
Yes, I've actually got a couple of questions. Potla Goody from Bloomberg News. Basically, what I want to know is what would the impact of the Kenya and Nigeria protests be on the country's investability? To the panel, and also on South Africa, what is the likely, is there anything that you see in terms of stocks and bonds shifting as a result of the GNU and its partners agreeing or disagreeing? And lastly, the investment case has been based on economic reforms. Do you see, the investment thesis has been based on economic reforms. What happens if those reforms are done away with, and how have the recent economic reforms in African markets influenced your rankings of investability?
Okay, that was all. I don't know who wants to...
I'll touch on Kenya, Nigeria, and maybe some of the economic reforms. I'll ask Isaiah to speak a little bit more on South Africa. I think in Kenya, I mean, we have a government of national unity here, but there as well, I think they've tried to resolve some of the protests and conflict in that regard. We're trying to make a more inclusive government, so that's one of the steps. The other thing, I mean, there's this cost of living crisis that's been bubbling up in many of the economies, and so we can touch on Nigeria in a bit. But I think here as well, in terms of the taxes, at least those for now are not in the spotlight. They've tried to look at their fiscal consolidation, not from a revenue perspective, but more from an expenditure perspective. So they've started reducing some lines of expenditure. So that could bring about some calm, and obviously the international community, and given where Kenya sits in the bigger scheme of things in the Horn of Africa, it's very important for the international community, the likes of the IMF, to help support Kenya through this transition. So I think, for the most part, there's going to be a lot of support to not get this, or to not allow this to spill over even further. I think in Nigeria's case, it's slightly different. Nigeria is a little bit more forceful when it comes to clamping down on some of these protests. So I don't think it's going to be as large. And we've seen in some of the news reports of late that it hasn't been as widely spread as the likes of Kenya. So I think, when you visit Nigeria as well, I think there's this momentum of all this change that's come about with the new regime. And that's largely positive, but again, the man on the street is starting to feel, the fuel price increases, and that I think it's going to be a little bit more contained than in the case of Kenya, though. Sorry, you mentioned economic reforms and what happens if these don't. If these don't continue, basically. So on the economic reforms, I think countries have been a little bit more committed than we've seen in recent years, just coming out of the pandemic, and that being, that's put a lot of cost on these economies from a health perspective, social perspective. So there's been the support from the likes of the World Bank supporting projects to help this. There's been social grants that have been incorporated in some of the budget. So comparing, a social grant element as well as trying to rein in some of the other expenditures. So I think there's a lot more commitment with some of these economies. And hopefully we don't have to backtrack.
Yeah, maybe I could also add, as far as how the reforms show up in the outcomes of our ranking too. what is quite important to underline is the fact that this is geared towards enabling investors to make long-term decisions. The construction of the model itself, it removes the volatility out of the data, which by implication implies even if a reform were to be done today, it's going to show up in these measures or in these pillars over time because of how the model is constructed. So a reform has to show up in improving market access. That can be immediate, as we see in some of the countries that have reforms their currency regimes. Ethiopia has just done one much more recently, where it allows corporates to hold foreign currency for a little longer than before. So that is immediate. It's important for a financial institution. It's important for an asset manager. But it's also important for a corporate. But in terms of how that translates into faster economic growth, it's going to take time, because the implication in terms of how corporates behave, it's only going to be seen over time. So it will only show up in the rankings over time. So one little action or one action does not necessarily show up in the performance in the ranking until it impacts all the other components in a way that is sustainable. Then it will show up in the rankings.
Can I say something? Oh, sorry.
Sorry. As I mentioned, some of the FX reforms, and I think if an African country lets go of the FX, they usually mean that they're quite serious about the reforms. So we've seen that in a number of countries already. Sorry.
No,
were you going to say something similar?
No, I wasn't.
Okay.
So, on the reform issue, always easier to talk about other people's relationships rather than our own. So let's talk about Argentina. And end of last year, Argentina, new government is appointed, and he steps in, and in the space of 3 weeks announces 300 reforms. This is absolutely extraordinary. But these reforms don't matter. And I love the point that's being made here. These reforms don't matter until you see their effect and impact. So investing on the basis of reforms is essentially investing on the basis of promise. And reforms in and of themselves are not good. The reforms need to be structural, they need to be impactful, they need to translate into economic inclusion, social fabric, etc., etc. Now let's talk about our relationship. And Kenya, really stands out as a recent example where a policy misstep, I think we can call it that, translates into social revulsion. And what we've seen is almost an entire cabinet replaced. This is putting your money where your mouth is.
You had an element of the GNU and what it means in our assessment. It's positive. There is a minimum common set of economic reforms that are structural, that are common across most of the political parties in the GNU, and therefore that increases the likelihood of implementation of those reforms. So it offers an upside risk to our expectation in terms of economic performance. Yeah. We're deliberately saying upside risk and not actual, because they still have to be implemented, and they're going to show up in economic performance over time.
Okay, so because I don't want to neglect the online audience who have been sending in their questions, I'm going to take 3 questions from the online side, and then I'm just going to farm them out to one of the panelists. So the first question is, how successful is the African Continental Free Trade Area? Who wants to take that one? Isaiah? Yes, no, maybe? Prof is going to take that one. Okay, great. So you'll answer that. And then the other question, perhaps Samantha, you can take this one. It says, what will be the single most important advice you'll give an investor considering a major investment in Ghana? Apart from political stability, what is the most important metric? And the one that I can give to Isaiah, and this one is actually for you. It says South Africa has been preparing to meet the FATF by 2025. Azar touched on ratings needing to be consumed with reasonable applications. Could he touch on the anticipated grey list exit?
Okay.
So let me get that and then answer those, and then we'll get the mic over to the lady in the green blazer.
Okay, so let's begin with the Africa Free Continental Trade Area and Agreement. It's at an initial phase. It offers huge potential. If you go and read into the report, you will get a better sense of what that potential looks like. To my opening remarks earlier on, intra-Africa trade is only 15%. The second lowest is the Americas at about 46%, which means there's a huge opportunity on the upside should we just double our intra-Africa trade. There are some constraints. It's infrastructure. Until people are able to move directly from country to country, move ideas from country to country, move goods from country to country easy, it becomes difficult. So we can agree, yes, let's open up the trade, let's remove all the trade barriers. But if there's no train to carry the bulk goods from here to Ethiopia, we can't do trade. Okay. So we need the underlying infrastructure. To Prof's point earlier on in terms of the deficit that is required, that offers an opportunity for investors that are long-term, in terms of their investment horizon.
Okay. Samantha, do you want to take the Ghana question?
Yeah, so I think Ghana has had an interesting dynamic, right? So of late, I mean, they've been growing 2 to 3%, but in the past they've been growing 5 to 6%. And obviously we've had the impact of COVID, the debt restructuring, etc. But I think the way I look at Ghana is when you look at the market accessibility and innovation sort of pillar. There, in terms of import concentration, I think they rank fairly well. So they don't rely on a single market or just a few markets for the imports. And when you look at export competitiveness as well, yes, there's the oil, and people think about the Dutch disease, etc. But they have also gold and cocoa. So it's quite a diverse sort of export market there. So overall, they rank sixth in our rankings, and they also do pretty well on social and development indicators. So I'd say a robust economy, a few glitches along the way, but I think there's massive potential there as well.
Okay, so I'm going to take 3 questions from the audience. The lady in the green blazer, if you could ask your question.
Good morning. I'm Nondu Duzondlovu from the African Development Bank. My question is on the methodology. First of all, I would like to say it's very impressive that you've added the Social and Human Capital Development Index in the methodology because it brings everything into a holistic view. So I will go back to the question you asked about the environment. There is the Climate Vulnerable Index where I think in 2022, 9 out of 10 countries in the world that are most vulnerable to climate change are in Africa. So I want to find out if it was considered like in the model to be included because I feel like it does change the investment appetite. For instance, in Seychelles, I know they are battling marine degradation and they have extreme weather events. Even in West Africa, the Sahel, most of the Sahel countries, like they are really struggling with climate impact, which could change the investment appetite. Also, if it could be possible to look into those countries that are highly vulnerable to climate change, what could be some opportunities that could be in those countries? Thank you.
Okay, cool. So we'll get the mic through to the gentleman over there. Prof, you were doing a lot of the climate answer questions. You want to give this a shot?
So thank you for your question. We do make explicit reference, and I think you and I are referencing the same data. It's the Notre Dame gain data. And that is in the report. We speak to it explicitly. It highlights the point that I made earlier that if you scan the world, the most vulnerable countries are African and the least prepared. are African. There's a statistic, I'll make it up on the spot, it's approximately right. There are 900 dams in Africa. We write this up in the report. There's 900 dams in Africa. 500 of these are in South Africa. So, this just speaks about the massive, massive infrastructure deficit and the huge potential. You can... From here, we're into the world of speculation, whether people actually get on and do something about this. But I want to try and jigsaw your point with Isaiah's point. You stole my question. Is for us to truly achieve continental upliftment, it needs to be broad-based. And for that broad base to happen, it is necessarily integrative, that we have to have economic integration. That means the shape and nature of infrastructure has to transform rather than from being extractive and to be connecting infrastructure. You start to add those dimensions in, and the flywheel begins to move. Now, that flywheel isn't going to happen by 2025. But you start to get this momentum, and that is the component that I see as being the East Asian comparator.
Okay. Maybe I could add to what Prof has just said now. A model, any type of model, is a very simplification of a complex reality.
Yeah.
It will not be able to capture 100% the dynamics that are taking place in an economy. So while the climate change is not explicitly incorporated in the model outcome, it is in the report, which is, if you go and read the report, you would actually combine the ESG-related components of the report with the outcome of the model. That can then give you much more information. The other aspect that is not in the report that you always need to take into account is culture.
Yeah.
Difficult to trade with the Francophone if you are traditionally trading in English-based countries because of the cultural nuances that you would not be able to capture in a model, which is why you have to go over and beyond. This is a starting point that gives you direction, but you still need some of the details that matter to decide where you invest.
Okay.
I think I also didn't answer the grey listing question.
Yeah, so what I'm going to add it with another question here.
Yeah.
It's just that because this is a live broadcast, I'm kind of also cognizant of time. So I want to take the gentleman's question and then the question on this side, and then I'm going to close the floor, and then I'll let you guys answer the other remaining ones. But let's take your question just quickly.
Great, thanks so much. Patrick Katabwa from Cat Africa Strategic Solutions. If you look at your top 10 overall ranking, all the countries have big port cities. And interestingly enough, on the connectedness, Kenya and Mozambique is not really on the right-hand side, even though they're investing quite a bit in their ports as well. The likes of Namibia and Senegal are on the right-hand side, so they're performing better than Kenya, even though they're much smaller economies. So quite keen, if you take a year or two view on Kenya and Mozambique, what are the potentials from a connectedness perspective?
Okay, cool. And then let me just get the gentleman's question so we can just all put them together.
Thank you very much. This is Peter Matlapi with Medtronic healthcare sector. Actually, Isaiah, I wanted to ask you the question on a free tax-free trade agreement, but I think you tackled that very well. The question that I'm not sure you covered it earlier is to what extent have you taken the country's ability to collect tax, as a factor to make it more attractive to doing business? Because I've done some work on that. It was quite interesting to see. So your thoughts?
Okay, and then I'm just closing the floor, questions, and if you want to interact with the panelists, they will be available after the event, so you can direct your questions. So let's take those two questions. I don't know who wants to.
I can start with Kenya and Mozambique,
okay, cool.
And then we can see who wants to add. So I can't remember the exact score in the global connectedness, but I can tell you that I think it's been over time where we've seen the likes of Kenya and Mozambique start to build up, the regional integration and connectedness there. So the SGR, obviously, in Kenya has been a part of that, and in Mozambique, I think it's taking advantage of some of the issues we have in South Africa and helping, helping with the ports as well. So it's taking those advantages. You could see them maybe in a couple of years once those developments progress, obviously improve in the rankings when we put them into those specific archetypes.
Okay.
Can I just add very quickly? I would agree fully with what Sam observes about the integration and rising connectedness, Patrick, of Kenya, Ghana, Senegal. These are fast improvers and integrators. Isaiah keeps making the point that this is a framework. We're not trying to forecast. These are structures. But if I were to speculate, I think if we meet again in 2 years' time, and we will, it's likely that Kenya is a probable improver in this framework. The same for Ghana, the same for Senegal. They're doing the right things.
Isaiah, do you want to take the tax-related question?
Yeah. So if you look at the economic stability and investment climate, it will be captured there. The tax to GDP ratio will be captured in your fiscal balances, essentially. The higher your tax collection, it means the less you need to borrow from outside to finance your requirements. So that shows up in your fiscal balance. So it is taken into account in the measurement. On the earlier question on grey listing, I think if you just listen to government communication and what they have done so far, they've made quite a lot of progress in terms of addressing those shortcomings that were highlighted. They're still looking to get out of the grey listing sometime next year, and their communication suggests that we are still on track. So we just have to wait and see. But a lot of the shortcomings have been addressed so far, which gives us a lot of confidence that we are likely to get out.
Okay. So as we get to the close of the actual panel discussion, I want to cheat this. So I want to try and incorporate some of the questions coming through here in some of the sort of closing comments and remarks, so just so I can kill two birds with one stone, and not trying to kill any birds or anything, but let's see what I can do here. Prof, perhaps you can touch on this one so when people download this report or get the reports and they read it, and you're corporate, how do I take this report as a corporate and use it? And then perhaps you can touch on how do we deal around this narrative of policy uncertainty in South Africa? I don't know, if you can do that. So I know, I give you the tough task. So let's park that one for you now while you think about the response.
Thank you.
Isaiah, for countries that are ranked lower, and they aspire to climb up the rankings, they want to be able to use your information to think a little bit better about how to put actionable reform or tweak things. What should they be focusing on? I don't know. I hate using this phrase, low-hanging fruit, but what would be the low-hanging fruit for them? And the same thing for you, Samantha. For those who are on the bond side, if you're a bond investor, how do I look at this report and interpret it and make it useful, so to speak? So, Prof, I hope you've thought of something.
Sure. Okay, so from a business, that's considering where to go, how to go, when to go, I think that this is even if I can sort of take the liberty of blowing my own trumpet our own trumpet a tiny bit, I think that this is a really rich piece of work. It brings this broad spectrum of dimensions to thinking about what makes countries attractive in terms of doing business, all the way from the ease of doing business through to the stability of society. What's my product? What's my time horizon? Why am I internationalizing? What's my purpose for going there? And what do I need to be able to build a viable, sustainable business in the place that I'm going to? Those are the types of considerations. As I made reference to culture as a dimension, so there are things that we have deliberately not included in this report. And a very obvious excluder is the so-called CAGE framework, which references culture. And why we do this is we're bringing here a global lens. We are not putting on the lens of South African investors thinking about opportunities in other markets. We have a global lens, and that would be investors from different markets, different countries, different backgrounds, thinking about these 50 plus markets. In terms of your second question, is the stability.
Yes, somebody asked that there seems to be a narrative that there's policy uncertainty in South Africa. He wants to know, is it real or is it a malicious figment of the imagination?
Wow. Okay, so very quickly, where South Africa has been absolutely world-class is in policy formulation, and absolutely disastrous is in policy implementation. And I like the point made earlier about a government of national unity creating a far larger element of accountability. And that my suspicion, Stephen, if I could single you out, we were speaking very briefly just before about coffee. I'd like to sort of raise my hand as one of the early optimists on South Africa under government of national unity. I'm not sure what day we are on now, day 131. Of uninterrupted energy supply. This was not a political ploy. This is a change in network delivery. And there is this growing component of accountability that I think we can look to under a government of national unity. So to me, that starts to translate fantastic policy into policy delivery, implementation.
Isaiah, as a policymaker,
so in most cases, some of these rankings that are viewed in a very combative manner from the region, where policymakers will be angry that their countries got downgraded or they rank very low. But I think the opportunity for policymakers is to look at what else can they do to improve their investment attractiveness. And this tool gives them exactly that, to say, you are ranked low on these factors, and if you were to do the reforms that improve those factors, you do well. We gave an example with South Africa on the social and human development. We are very low on that. Inequality, unemployment rate, the human development index. So if policymakers were to address that, then it will improve the overall ranking of the country and therefore the investment attractiveness. The point that we made earlier on to say the model does not give you results that are set in stone. It gives you the ability to change the future because you know what are the drivers of your current reality and how can you change that, what can you change to actually change the future.
Samantha?
Yeah, so I think in these economies, firstly, there needs to be bonds that you can invest in, so open to foreign investors if that's the case. But I think then looking at this dynamic overall health of the economy is obviously very important. So that ranks under the first pillar. Economic stability and investment climate is very important as well. So you're looking at inflation and FX stability and liquidity. That's essential for bond investors. So you want to know if your investment is being eroded, or if there's a FX liquidity constraint and you aren't able to take out your funds or exit the market. I think the other thing is on the market accessibility and innovation. So there we look at import concentration and export competitiveness as well. So you don't want major shocks and large BOP problems later on. So I think those pillars are important. And then lastly, the social and and human development. We've touched on it before, but I think it's important generally, but also for those looking to invest in things like social impact and development impact bonds as well.
Okay. We've spoken about a lot over the past, I would say, hour and a bit, and there were still quite a lot of questions that came through. And if you get the report, you'll notice right at the end, apart from the appendix section, there are contact details if you want to email and spam those people who put the report together. If there are any specific questions that you may not have gotten a chance to ask, especially if you are joining us online. And if you are in the room and there were questions that you also were not able to ask, as I mentioned, the panelists will be available after the event. On that note, it's time to wrap things up. Thank you so much for those of you who were joining us online and watching. It's been really great engaging with some of your questions. And I hope you enjoy the report and you find it insightful. And hopefully next year we'll have a different story to tell, an even better story to tell about how some of these countries rank in the following year. So thank you so much for tuning in, and thank you so much to the people in the room. It's a goodbye.